It really is shocking to me that over $1 trillion worth of perps or perpetual futures contracts are traded every month. That's trillion with a T. Yet most people don't understand perps at all. Like stocks and bonds, I expect perps or perpetual futures to continue to grow and become among the world's most important financial instruments. And really, they're not far off. My goal with this podcast is to take your understanding of perps, of this seemingly complex financial instrument, to the 99th percentile, regardless of where you're starting from. For those of you who are new, welcome to the Law of Code podcast. I'm your host, Jacob Robinson, a former securities regulatory lawyer turned podcaster. My mission with this podcast is to help you understand the legal layer of emerging tech, with the goal being that we all understand the rules that shape society so that we can create better rules and live in a better world. It should be the best legal podcast that you've ever listened to. That's the standard with every episode that I publish. I spent about 100 non-billable hours, no joke, on this one podcast. This was a process that began about 2 months ago. I read everything that was relevant online. I used tools to scan things like the Ethereum blockchain to unpack what's happening at the technical level. Then I spoke to the world's leading experts, whom you'll hear from throughout this episode. That'll include CEOs like Brett Harrison of Architect, Jake Chervinsky of the Hyperliquid Policy Center, as well as the leading lawyers. This podcast ends with a discussion about the regulatory implications of perps in the decentralized space. So we'll hear from Hyperliquid's Policy Center's CEO, Jake Chervinsky, and Policy Counsel, Brad Bourque, two legal minds that are really at the cutting edge of this field and really pushing things forward there. Hyperliquid, if you're not familiar, is a perp platform that is considered the most profitable startup in the world on a per employee basis. I haven't verified this figure, but it's been reported that Hyperliquid's team of 11 generated $900 million in profit last year. Dang, that's a 900 million more than Law of Code podcast. Now, I'm confident that there is no better explainer on perps on the internet, particularly in podcast form. And if there is, or I missed anything, please let me know at Jacob Robinson, JD on X. I think it's the same on LinkedIn. I just want to make this better. I want to make this something that everyone can learn from. As you will tell and will be pretty obvious, there aren't any sponsors of this podcast yet. Hopefully working, on changing that with quite a few people now. But all I ask, I'm not getting paid for this. If you learn something from this, please just share it on your social feed. Sharing it on your social feed really goes a long way to helping me grow the reach of this podcast. So thank you for doing that, or at least considering to do that. If you're me, I'd probably be like, oh, I'm going to do that later. But hey, if you do it now, then, that's one thing off your list. So anyways, thank you. We'll begin the podcast after a brief legal disclaimer. Just a note for lawyers in Canada, this podcast has been approved by the Law Society of Ontario for the number of hours you listen to it. So if you listen to it for 3 hours, that'll be a 3-hour substantive CPD credit you can get for it. For my American friends, I am working on getting this approved for CLE starting in New York. That should be coming soon. If you're not a lawyer, do not worry. You do not need to be. Nor do you need to be an expert on crypto or financial markets. I explain all the jargon, as do my excellent guests. There's about 8 of them across the entire podcast. You'll also hear some clips from Richard Nixon, so stick around from that, as well as CFTC Chair Mike Selig. Let's start with the basic question of what is a perp after, as I said, this brief legal disclaimer.
Anything mentioned in this episode by Jacob Robinson or his guests is not legal advice or investment advice. All opinions are Jacob's and his guests alone. This show is solely for information and entertainment purposes only. Jacob and his guests are not your lawyers, nor are they investment advisors.
Okay, so first, what is a perp? At its core, a perpetual futures contract, or perp, is really just a way to bet on the price of an asset going up or down without owning the asset itself. So instead of buying Bitcoin or gold or a barrel of oil, you're buying a financial contract, a derivative, which just means the value is derived or comes from something else that tracks the price of Bitcoin or gold or that barrel of oil. Next question becomes, well, why wouldn't I just buy the Bitcoin or the oil or the gold itself? Why would I buy the perp? Here's Brett Harrison. He's the CEO of Architect and the creator of AX, to explain why perps have exploded in popularity, because they offer a simple solution to what was a complicated problem about buying certain assets.
There's an easy answer. Where can you go to buy and sell spot barrels of oil?
That was an easy answer.
That's answer number one. Answer
Right.
number two, how do you go short a barrel of oil? You'd have to go borrow a barrel of oil from someone else so that you can sell it short. It's impossible. And so the problem here is oftentimes the actual commodity is something that might be physically difficult to move around, to store. You might not want to deal with the complexity of actually taking delivery of whatever the thing is. For oil, it's like, getting a tanker in the harbor with your name on it. And for wheat, it's like getting a receipt to wheat in a silo and having to deal with all that. Imagine having to take delivery of cattle. These things are quite complicated. And then going short is even harder.
So rather than buy the asset itself, which comes with risks relating to storage, transportation, quality, etc., if you think the price of the asset will rise or you need to hedge your exposure to the price of that asset, you go long or you go short. And if you go long and the price rises, you'll make money. If you think the price will go down, you go short and you profit if the price falls. It's a way to hedge. It's a way to make money. There's a lot of jargon here, though, so let's unpack that. Since you're smart, you probably guessed that perpetual means references perpetuity, right? The contract never expires. And that's where perps are novel. Unlike perps, traditional futures contracts have expiry dates. A futures contract sounds more complicated than it is. A simple way to understand that, and this is the same with most things in law, is just invert the words futures contract. It's a contract for the future delivery of an asset. You're buying something now that can be redeemed for something in the future. A movie ticket isn't a futures contract, but you can think of it like a futures contract where you buy a ticket for the movie that you'd redeem to see the movie in the future. It's sort of like that, but for trading. Here's Mike Frisch. Mike's a partner at Croak Fairchild and a former CFTC senior trial attorney. We'll explain what the CFTC is in a bit to explain why futures contracts existed in the first place.
Futures are designed to allow traders or hedgers to express a view about where they think an asset will be at a certain point in the future, right? So let's say you're a farmer and you just planted your crop in the spring and you're harvesting in August. You can buy a futures contract that expires in August and you can hedge your risk as it would be in August, and you can lock in your price early, right? You can lock in your price in the spring and you can have the expiration set for August. And the futures markets express the market view, not only what prices are today, but where the market thinks they're going to be at a point in the future.
Since, as I said, most futures contracts have expiry dates called settlement, and most people are buying these for financial reasons, futures contracts are typically either closed before settlement occurs or they're rolled, meaning pushed to a later expiry date, and thus delivery or redemption rarely occurs. About less than 2% of futures contracts actually result in physical delivery. But because all these contracts have different delivery dates, the money sits in a bunch of different buckets across the different expiry dates, with people constantly opening and closing positions. This is called liquidity fragmentation, meaning the liquidity or the money in the market is fragmented or split across these discrete different buckets. Liquidity fragmentation is a problem because when buyers and sellers are spread across a dozen different contracts instead of concentrated in one, the gap between what the buyers will pay and what the sellers will accept gets wider. So every trade costs participants in this marketplace more than it should, or maybe more than it needs to. Are you following me? I sort of just jumped in with a ton of jargon and sort of futures contracts and everything here. We'll rewind in a second, but really the key thing to know here is that a traditional futures contract requires redemption or delivery of an asset. The redemption or delivery of an asset causes it leads to wider gaps, as I just mentioned, between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, because there are fewer participants in any one contract. It also leads to slippage, which is a way of describing the difference between the price you expect to pay and the price you actually got. So for example, if you start buying at $100 and there's not too much liquidity or money in these contracts, you could quickly move the price up beyond what you were hoping to pay for that because you've eaten through sort of all the sellers that were available. It's also harder to exit the market, right? There's less buyers and sellers for particular things. If you're holding a December contract and everyone has moved on to March, you may have to accept a bad price just to get rid of that contract. Perps offer a pretty novel solution to these problems by concentrating liquidity or all that money in one instrument that never expires. So compared to futures, where it's traditionally spread across multiple contracts, with perps, you've got it all in one area. So that solves sort of those three issues we just touched on. Perps really are just a logical solution to obvious problem of this expiry date, which, since you are one of the smartest people in the world to be listening to this podcast, you're probably thinking, wait a second, why do futures contracts have expiry dates anyways? And you know, I'm sure some of you are derivatives lawyers who know this and experts who know this already, but I think it's worth revisiting the history here. And I'm pretty confident you're going to learn something new, even if you already are an expert here. The easiest way to understand anything is to understand the evolution of the history. And futures contracts are no exception to that. Futures have been around for hundreds of years, maybe thousands. The modern American version of a futures contract emerged in the mid-19th century as a tool for farmers and their buyers to reduce the risk of price fluctuations by agreeing to a price months ahead of the delivery. Pretend I'm a farmer and I'm growing wheat in the spring and I want to sell it in autumn for the autumn harvest. Thankfully for me, you, the listener, you are a bread maker and you want to buy some wheat from me, and we both want to know what prices you're going to buy the wheat from me at. So we agree now, let's say in May of 2026, for what price you're going to buy it for. Let's say, I don't even know, do they use bushels? You're going to buy it for $20 a bushel. Maybe that's a steal, I don't know. But you're going to buy wheat from me for $20 a bushel, and I'm going to deliver it to you for $20 a bushel when you redeem it in the fall. That's a futures contract. We're agreeing now for a future price. We're contracting now for a future delivery at a certain price. Here's Ryne Miller, who you'll see intermixed throughout this podcast alongside other guests, all of whom are experts on this. Ryan's also a partner at Morrison Foerster. He also worked at the CFTC for years and was legal counsel to former CFTC chairman Gary Gensler. And Ryan's going to explain a little bit more about futures contracts and why we had these delivery dates.
So let's remember why we have financial markets around commodities prices, right? You had, for the longest time, this mismatch between producers of commodities and buyers of commodities. And so the producer of the commodity says, I'm going to grow something and it's on a timeline. I can't sell it tomorrow, but I have to fund my production of this thing, of this commodity. Let's just stay with agriculture, that I'm not going to be able to sell for some months from now. But I'm pretty sure, based on history, how much I'm going to be able to produce. And I'm pretty sure I know who's going to buy it. My issue is my cost of production is happening today, and I don't get to sell it until down the road. So how do I make sure that once I do sell it, I'll make enough to cover my cost of production? And the way you do that is to try to lock in a price today for something I'm going to do tomorrow or a week from now or a month down the road. And that was not uncommon, even if we go back hundreds and thousands of years. And that was basically a forward contract. And let's just put the idea of a forward contract on the table for your listeners. It's an agreement between two parties to deliver a commodity in the future at a price that we set today.
Yeah, that was a great explainer. And as you'll note throughout this podcast, I turn to experts like Ryan and many others to explain these concepts and what they're seeing and what they're doing in the market. So don't worry, it's not just me. And as Ryan was alluding to, the expiry date was not a bug. It was a feature. It was actually the feature. Someone had to deliver the wheat upon expiry, and the contract has to expire to force that delivery. Without expiry, these contracts were kind of worthless to the buyer and the seller because both wanted to move products or receive products. So in Chicago, and it all comes back to Chicago, as you'll notice throughout this episode, which at the time, and sort of remember this is mid-19th century, Chicago was the terminal market of middle America. The demand for these contracts in Chicago became so large, there was so much sort of buying and selling of wheats and sort of other commodities that were like wheat, that a group of merchants formed the Chicago Board of Trade, which is now part of the Chicago Mercantile Exchange, the CME, sort of the biggest derivatives marketplace in the world, to set uniform rules on buying, weighing, and grading the wheat. Ryne explains more.
What started to happen over the years is these contracts became very standardized. And one key component of the contract was the type of the commodity, like the type, quality, grade, standards. The type of commodity that you could sell for future delivery became very standardized because I wanted to know exactly what I was getting, and I wanted to buy what was market convention. The other thing that became standardized was the delivery dates and timelines. It's like, all right, I know I'm going to have some sales in March and in April and in June. Let's start structuring these as monthly settlements. So I'm going to sell you this very well-defined, standardized commodity at some commercial convention amount at some defined date. And we're going to do this over a period of dates into the future. And all of a sudden, everyone had these contracts for future delivery. And they said, why don't, these contracts, as prices go up and down, my contracts are locking me in at a particular price. The contract is actually worth money. And then from that, you had these board of trades where people started just trading the contracts amongst themselves. That evolved into what we have today as modern futures markets. That is a very fast explanation of moving from forward selling commodities into standardized forward sales, into calling those futures, into those trading on boards of trade. But that's sort of the history of this. The agricultural markets needed a way for producers to be confident they could take out a loan to go and do this production. And on the other side of it, buyers needed to have some confidence that I could get my milk or my wheat or my corn. I knew the price that I was going to pay for it. Whatever I'm going to do on the other side with that commodity, I can do it profitably because I know my price.
So this demand for hedging pricing risks became big enough that the idea survived the difficult years of experimentation, kind of like what's going on through crypto right now, to produce what is now the largest derivatives exchange in the world, the Chicago Mercantile Exchange, known as the CME. Copies of the CME have spawned across the US and the broader world. So futures were mainly limited to things like wheat, physical, tangible goods, until the 1970s. And since, as I said before, you were so smart and so good looking, the question you're probably wondering now is why that changed, right? Why was it no longer limited to tangible goods, physical items like wheat and oil, until the 70s? Well, after World War II, the major economies had agreed that their currency, and this is a quick history lesson about sort of fixed currencies, and this is a pretty interesting concept. So after World War II, the major economies agreed that their currencies would be pegged to the US dollar, which itself was pegged to gold at $35 an ounce. So that meant there were fixed exchange rates, and these removed the need for any futures on currencies. But then in 1971, US President Richard Nixon did something that really changed the world. In 1971, President Nixon suspended the convertibility of the dollar, the US dollar, to gold. Here's Nixon. I literally got the audio clip for you on what was supposed to be a temporary government measure. Here's Nixon in his announcement that was broadcast to the country.
We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. The speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Now, Nixon's announcement had immediate effect. It immediately took America off the gold standard upon which the US dollar had been fixed. This created a new risk for businesses, right? There's now exchange rate risk, because until then, a US company selling goods to a German buyer knew exactly what those Deutschmarks would be worth in dollars when payment arrived. Again, this was before the euro. Since it was all fixed to either gold or the US dollar, meaning the value of Deutschmarks compared to the US dollar would remain unchanged. Nixon's announcement ended that. It meant American businesses and their German counterparts had no idea what the currencies would be worth in a few months that they were transacting with. Now, economists had sort of resisted this concept of fluctuating exchange rates until Milton Friedman, a Nobel Prize winning economist at the University of Chicago, of course, it always goes back to Chicago when we talk about futures, wrote The Case for Flexible Exchange Rates in the 1950s. Basically, what he said was that flexible exchange rates worked better than fixed rates, and that trying to maintain fixed rates was incompatible with free trade and nation economic independence. Things like printing more money probably were difficult to do when you had these fixed currency rates. But back to 1971, as we know, futures were exclusively for physical commodities at this time. But Leo Melamed, the enterprising chairman of the CME at the time, which is the Chicago Mercantile Exchange, always back to Chicago, had a novel idea. What if we had a futures market in foreign currency? So Melamed wanted to validate that idea. So he went to his fellow Chicagoan, which is apparently what they call themselves. I thought Chicagoite would be better, but they call themselves Chicagoan. Anyways, Melamed, remember, he's the chairman of the CME. So he met with Milton Friedman, that economist, for breakfast at the Waldorf in New York, and convinced Friedman to write a paper, a feasibility paper, basically asserting that there would be a major need for a futures market in currencies. Then the CME chairman used that to launch the International Monetary Market in 1972, which I believe was the first exchange in the world to specifically trade financial futures. Here's Ryne Miller, a partner at Morrison Foerster, to explain a little bit more about this period.
Leo Melamed, he's a legend at CME, and your listeners should look up Leo Melamed. He's really the father of modern derivatives markets and the commoditization of financial indices, interest rates, FX or otherwise. And Chicago was the leading place where this was happening. They went to Congress and they created the Commodity Futures Trading Commission in 1974. Previously, what is now the CFTC, which regulates derivatives in the United States, was just a department inside of a division inside of the Department of Agriculture. It was called the Commodity Exchange. I don't even remember, Commodity Exchange Authority maybe. But the CFTC becomes an independent agency in 1974. And importantly for your listeners, the definition of commodity, which was the baseline for which derivatives could be regulated by the federal government, it only included agricultural products until 1974. And then that definition, along with the creation of the CFTC, is expanded to include the phrase that's important is anything on which now or in the future there may be a futures contract traded on it. Give or take, that's the language. I'm not going to quote it, but it brought in the idea of financial indices and benchmarks. It brought in the ideas of foreign currency and rates, or FX trading and rates. It brought in the idea of energy and metals. You really didn't have standardized markets around energy derivatives and even metals derivatives until the definition of commodity is expanded out in the early 1970s by Congress.
Yeah, Ryan's absolutely correct. Prior to the CFTC, there was the Commodity Exchange Authority, which sat within the United States Department of Agriculture, and they were tasked with administering the Commodity Exchange Act of 1936. Before that, there was the Commodity Exchange Administration. There was also an earlier ancestor, the Grain Futures Administration, which was created by the Grain Futures Act of 1922. Each of these statutes and entities played a role in evolving the rules around physical delivery, settlement, a concept that Ryan explains next. It's still a thing, of course.
So CME, so Chicago Mercantile Exchange, still has a ton of physically delivered products, and they have a lot of volume in physically delivered agricultural futures contracts. And there's huge specs, contract specifications around where delivery has to be made, to which warehouses, who's eligible to make delivery in those warehouses, what grade range can be delivered. It's not as if every truck of corn is the exact same grade, but there is some range of quality that can be delivered. There's premiums and discounts depending on where you fit in the quality metrics. There might be premiums or discounts depending which warehouse you deliver into. And so if you want to opt into physically delivered futures contracts and hold the expiry, you need to also understand a whole logistics side of the business to actually make and take delivery and where the cost might come from on that side of it.
Okay, that was a cool history lesson. I hope it was a little interesting, but I was explaining perps. So let's get back to that. Where did perps come from? Well, the idea from perps came from a 1992 paper by a Yale economist, Robert Shiller, who was trying to solve a problem for assets that are hard to price, like real estate. His proposal was basically that people could hedge exposure to the real estate market through a derivative, remember the value is derived from something else, with no expiration date that paid out continuously between sort of either positions, either longs or shorts, based on the underlying assets' cash flows, so like rent in the case of real estate, minus an interest charge on the futures price. Shiller's thesis was that if you have a conventional futures market, everyone's going to pile into sort of the short-term futures, and hedgers probably would, all things considered, prefer a longer time horizon, but they might not get the liquidity they need. And he was absolutely right. I mean, that's why perpetuals are so popular now. But the problem was Shiller was ahead of his time. Perpetual futures never took off because they couldn't, because crypto solved a lot of problems that existed in the traditional markets. Here's Katherine Kirkpatrick Bos. She's a lawyer and a derivatives expert and general counsel of StarkWare, who explains Shiller's thinking and its impact briefly.
He thought, whoa, this could support better price discovery and risk management in markets for both tradable and non-tradable assets. And this really, this kind of economist-oriented work laid the groundwork for what we think of now as perps in crypto markets, and illustrates a lot of the upside to enhance market efficiency and enable cash settlement based on, very index-based, transparent, like kind of timely asset valuations.
All right, now let's go back to the delivery theme. Remember that for commodities like wheat, physical settlement was the whole point. But physical delivery is different with financial instruments. Here's Ryne Miller again to explain these two types of derivatives, at least when it comes to settlement.
Well, let's go back to like first principles. There's two fundamental types of derivatives contracts, and this is around settlement. One, at the settlement or expiry of the contract, if I've contracted to deliver something, I have to actually show up with the commodity or the currency or the whatever and deliver it. That's a physically delivered contract. Most of the volume globally that trades in derivatives is on financially settled contracts. And what that means is you pick a base currency, let's just call it the US dollar, for example, and you dollarize the value of your claims at delivery. And instead of showing up with corn or whatever, you look at the price that you'd agreed upon and you look at the price where the market is, you dollarize the value of it, and the winner pays the loser that amount of dollars.
So in our digital age, you don't need physical delivery of a financial instrument. And even if you do, physical delivery feels very different when the item is something like Bitcoin. Anyways, most of these new financial commodities settle in cash. Here's Katherine Kirkpatrick Bos again.
When I say cash settlement, that's where no actual asset changes hands. The parties just exchange money, whereas there's also physical settlement where the underlying asset is delivered when the contract ends. So a lot of the traditional crypto futures, at least in the US, it's cash settled because these designated contract markets don't want to deal with the crypto itself.
Yeah, that's exactly it. The parties exchange money representing the difference between the agreed price and the final value. It's very logical. The next question becomes, if there's no delivery of goods, do you still need an expiry date? Maybe. That's actually one of the big questions, because some people think you do, some people think you don't. Delivery might seem unnecessary when you buy a futures contracts for assets that could be settled in cash, but delivery or expiry is actually the glue that makes futures work. Although, as we'll see, perps introduce a different type of glue. Here's how the glue works in traditional futures contracts. As expiry approaches, meaning the date when the actual delivery will need to occur, or in the case of purely financial instruments, the settlement date in cash, anyone who holds the contracts knows it's about to resolve or become valued at the actual asset price. That's a lot of jargon. Sorry, let's just take a step back. Imagine a barrel of oil costs $80 on the open market today. So you can go find a barrel of oil, buy it for $80. That's what we call the spot price. A futures contract entitles the holder to take delivery of that same barrel of oil next month, let's say. And let's say that futures contract is trading at $100. As the expiry date approaches, that gap's not going to last. No rational buyer is going to pay $100 for something that costs $80 on the open market. So the futures price falls towards $80. If the futures price is trading too high, arbitrageurs will sell the future and buy the actual spot or the actual barrel of oil, locking in the difference without really taking on any risk. It's a great way to make a guaranteed profit, and it's sort of a free market mechanism that makes this whole system work. That's the glue that I was referring to. Again, it's the possibility and sort of the necessity of delivery that makes this work because it forces the prices to converge. Here's Ryne Miller again. Remember, Ryne worked at the CFTC, so he saw this firsthand.
That settlement date drives the derivatives contract to the real world. And then the word at the CFTC is convergence. And when I was a young lawyer, I worked at the CFTC, and the wheat contract was not converging to the underlying spot price of wheat. Like what you would pay for wheat at your truck at the warehouse was a different price than where the futures contracts were settling to. And people were flipping out about this. The whole point of an expiry on a futures contract is that the contract itself has to drive towards the underlying physical price, because arbitreurs will step in and say, if it's trading dislocated from the underlying physical market, well, I can make money there because I'm going to get delivered the physical. I'll accept it and go sell it on the spot market. So convergence is critical for any type of derivatives contract to work.
So if the futures price for a barrel of oil drifts too far from the actual price at the time of expiry, these arbitrageurs step in and pocket the difference risk-free. This is supposed to keep the prices aligned, which brings us back to perps. If a perp never expires, then how do you take delivery of it? There's no final moment of settlement, no delivery of cash or an underlying commodity that is being brought to you or that you can pick up. There's no convergence. So how does the perp contract price align with the actual spot price? Another great question, which is why I like you. That's incentives. So in the case of futures contract, the incentive there is the delivery date that acts to incentivize these arbitrageurs to align the price back to the spot date as it approaches that final day. In the case of perps, the incentive is different. The incentive in the case of perps is what's called a funding rate. Again, perps have no delivery and no expiry, so they needed another way to determine whether holders are in the money or not, i.e. positive or negative compared to the spot price. So perps operate through this funding rate, which ties the perp price to the underlying spot price. Remember, this is the actual price of the asset at any given time. The funding rate is a type of pricing glue similar in structure to what Shiller, remember that Yale economist, proposed in 1992. He imagined a flow where one side pays the other every day based on the gap between what the actual price is and what the perp price is. Only it's a little different in how the crypto industry has implemented perps compared to what Shiller thought. Shiller's idea was in observable cash flows from things like real estate, and then he would add an interest charge on top of that. Crypto perps are anchored to the spot price through a fee paid between traders. Remember, in Shiller's time, he was thinking more about real estate. But with crypto, you can see the spot price at any given time. These markets are much more liquid and observable than for things like real estate. Now, the funding rate works in 4 simple steps. I'm going to let Katherine Kirkpatrick Bos explain it, and then I'm going to go through it step by step. So here's Katherine.
You have a funding rate mechanism that kicks in, and that can vary depending on the perp, but that effectively incentivizes traders to keep the perp price close to the spot price. It really shouldn't vary, because if the perp price trades above the spot price, the longs pay shorts a funding fee and vice versa.
Okay, let's walk through it step by step. The specifics change according to the platform, but really this is how it works no matter what platform you're on, or at least on every platform that I've seen. So the first step is the price. perp platforms are continuously comparing the perp price to the spot price using an oracle or an external price feed. I'll explain more on that later. But all you need to know is that the perp platform is looking for a gap between the price of the perp and the price of the asset that it references. When it detects a gap, that's when you go to step 2. And that's step 2 is the fee. If there's a gap between the spot and the perp price, the protocol calculates a fee proportional to the size of that gap. So this fee is paid periodically by the party on the crowded side. So think the side where the perp price sits, either above or below the spot price. The bigger the gap between the spot price and the perp price, the higher the fee that's paid. And that fee is the funding rate. To make it a bit more tangible, let's go back to that oil example. If the perp price for a barrel of oil is $100, it's now above the spot price of a barrel of oil at $80. So in this case, the longs, which are the people who believe in the long-term price increase, pay the shorts, the people who think the price will decrease, because the longs are on the crowded side where the price sits, the $100, the perp price, which is above the $80 price. So here, the longs pay the shorts because the perp price is above. If it was the opposite, the shorts would pay the longs. And that payment is the third step. So these calculations, these payment calculations, are done at different time intervals depending on the platform. I believe Hyperliquid uses 8-hour intervals to calculate the funding rate. But basically, at these different time intervals, a percentage of every position is automatically deducted and paid directly to whatever position is sort of in the money. It can get expensive, right? If you're holding a position that isn't accurate at the time. And a good way to conceptualize this or think about it is in the movie The Big Short, where Michael Burry is bleeding money as the housing market fails to crash. The premiums that are referenced are sort of a similar concept, directionally at least. Now, the final steps of this 4-step process of the funding rate is price correction. The funding rate is essentially a tax on anyone who is on the crowded side of the trade. If too many people are long, longs pay the shorts every hour or every sort of period. The more crowded the one side gets, so let's say the long side, the higher that tax becomes. Eventually, it stops being worth it, and some people close their long positions. Some traders go short just to collect the payment. And that selling, that pressure on either side, pulls the perp price back towards the spot price. And as the prices reconverge, the tax shrinks, the market settles into balance. And that's how the system finds equilibrium. That's the glue that replaces the delivery or the expiry that we have in traditional futures markets. Okay. That was one of the most complicated parts of this whole thing. So I think you've got a good understanding. Here's Architect CEO Brett Harrison to explain how their platform AX calculates the funding rate.
So we do it very simply on Architect. Once per day, whenever the underlying is open and there's the most liquid kind of event to take a snapshot of the underlying price, we take a snapshot of an underlying benchmark. We take a snapshot of where the perpetual is trading. And whatever that difference is, that is the funding amount. That's the amount that the long holders of the contract owe the short holders of the contract. If it's a premium, if that future is trading over the underlying. If it's the reverse, if it's a discount and the perpetual is trading under the benchmark, then shorts will owe the longs that amount. So for example, let's say we do a perpetual on the Japanese yen. We source kind of the official 4 p.m. UK WMR fixing rates from LSEG and Refinitiv. We get those in at 4 p.m. UK time. We take a snapshot at 4 p.m. UK of that price, and then a short VWAP of where the perpetual is trading. We take the difference, and whatever that is, that's the amount the longs owe the shorts per contract. So you can kind of think of like what it ends up doing mechanically is turning the perpetual into a one-day auto rolling forward. It's like every day you're in a one-day forward contract. It's almost like it expires and immediately re-rolls at the exact same price that you're at. And that's the mechanism that keeps it in line.
Okay, man. That funding rate stuff was pretty heavy. There's clearly a lot at play, but you got it. I just want to give a quick refresher because a lot of people told me they've had to rewind these podcasts because it's pretty in-depth. So I appreciate the compliment, but I definitely want to make it easier for everyone to understand this stuff. So here it is without any jargon. Well, a little jargon. The perp price is tracked and compared to the actual price of the asset. That's step 1. Whenever there's a gap, step 2, the side where the perp price sits. So that's either above the spot price or below the spot price. Whichever side is sort of on the side where the perp price sits, they pay fees to the other side. That's step 3. Those fees in step 4 drain the accounts and sort of incentivize everyone to bring that price back closer to the spot price. And that's the completion of step 4, and that's how the funding rate works. Remember, the goal is to anchor the perp price or have it converge to the spot price on a long time horizon. And that's what Robert Shiller wanted. I think his name was Robert. That's what Shiller wanted, that Yale economist. And that's really how perps work. Amazing. You've got it. But we're just getting started. I wanted you to have that background so you could understand the rest of this podcast. Now, one thing that I briefly mentioned was that crypto and blockchain technology solved the problems that existed here. For example, in traditional markets for futures, an expensive central clearinghouse sits between buyers and sellers. That's accompanied by a host of other things that sort of add friction to the transactions, whereas crypto can be 24/7, doesn't close on weekends. Before that, you didn't really have a way to do something like this. Here's Brett Harrison, the CEO of Architect, to explain a little bit more about what happened with perps and crypto.
So around like 2012, 2013, some of the first non-US and unregulated futures exchanges in cryptocurrencies launched this derivative product, which of course was somewhat based on Robert Shiller's kind of 1990s paper about perpetual derivatives and kind of resembled in fashion to that original idea. And it just took off because it's sort of like the exact perfect vehicle. Again, you're able to get leveraged long and short exposure 24/7, and you don't have to worry about things like contango and backwardation and, rolling over the course of every month or every quarter and handling the operational complexity there.
Now, unlike wheat or interest rate futures, digital assets like Bitcoin trade 24/7, 365 globally with no central exchange and no closing bell. As Brett explains, the first use case, like in most industries, and this was true for railroads and cars and everything else, has mostly been speculation, though I suspect that also changes over time. Here's a clip from my conversation with Brett where he admits that, hey, this is 99% speculation. So one thing that I'd be curious to hear from you, if you have data on this, is like, what percentage of perps now do you think are being traded for hedging purposes compared to, trading purposes to try to find alpha there? Because I think a lot of people, when they think about the history of futures, it was like, oh, clearly this is just farmers trying to get some money up front, trying to hedge their bets and sort of allocate for their costs. In the case of perps, it's hard to really tell with things like compute and oil and gas and crypto. So like, what would you say the percentage looks like now?
I think today it's probably, 99+% speculation. I think perps and regular futures have started in the opposite points in history. Futures started as wheat farmers, looking to find some way of hedging their exposure and finding a place to transfer their risk. And as that moved onto electronic venues and anyone was able to participate and any retail started to be able to participate, it became more of a mix of speculative reasons and hedging and true hedging. And so there's like a good, healthy mix. And it depends on what the product is. For certain agricultural products, it's a larger mix of hedging versus speculation. For something like the S&P 500 futures, it's probably, my guess it would be kind of split down the middle. People who are using that to hedge market beta versus people who are speculating. Because perpetuals started in an unregulated fashion, the true hedgers of the world typically can't participate in such a market. So I think that really started as entirely speculation and arbitrage.
What I think is important to understand here is that these unregulated entities and even just this idea of perps has persisted over time despite attacks from regulators and the difficulties of operating in a legal gray area. So clearly they offer something that the market wants. The most important point, though, in all this is ensuring that it works. And that requires a close tie-in to the spot price, which is that reference price. And that really, like, if you don't have that working, the funding rate won't work and everything else is going to be thrown off. Because the contract never expires, there's no natural moment of reckoning, no natural moment of convergence. There's no threat of physical delivery. Since the perp price never expires, the funding rate needs to work. Some think it might be a weaker long-term price anchor because, futures have that delivery. Some actually think it might be better because you're not waiting to that settlement day for the anchor to kick in. This anchor's working 24/7, 365, and you're not waiting for that end day. Now, question then becomes, okay, well, where do you get this anchor price from? And that's where it's different for every platform. On Hyperliquid, for example, the Oracle price is computed by validators. These are computers that run the network as a weighted median of prices from major reference exchanges. That weighted median is made up of, at least sort of as the last time I looked, Binance, OKX, Bybit, Kraken, KuCoin, Gate.io, and a few others, with weights given to each of those exchanges, the most to Binance. Now, the final Oracle price used is the weighted median of each validator's submitted Oracle prices, where the validators are weighed by their stake. And that's from the docs. Now, remember, the validators are sort of like the people that are participating in this compilation of the price. And remember, these are weighted by stake. So a validator with a lot of tokens staked has more influence over where the median price lands, the spot price is. And remember, that spot price determines the funding rate and the fees. Hyperliquid has 35 validators as of, I think this was like April 2026. The 25 were active. The largest are the Hyper Foundation, which controls about 47% of the visible stake. So they do not have a majority on their own, so they can't unilaterally dictate the Oracle price, at least based on this, but they are the largest lock by a wide margin. The next largest single validator is Anchorage by Figment, has about 7.4%. So again, this is all public, which I think is part of what makes this technology amazing. And what's great is at the end of this episode, you're going to hear from Hyperliquid Policy Center's Jake Chervinsky and Brad Bourque. They were very candid about sort of how they think about this. So stick around for that. Anyways, this is obviously a centralization concern and something regulators are going to think about, and something the people like Jake and Brad at HPC are thinking about. There's also centralized platforms like Architect. Brett Harrison, the CEO of Architect, explains how they determine the spot price on AX.
We only reference trusted third-party benchmark prices that have enormous amounts of liquidity at the time of the benchmark calculation and are computed by an independent source. So for example, for our equity perpetuals, which aren't something that we'd be able to do in the US in the short term, given those might be, either single stock futures or securities-based swaps, it's kind of its own can of worms. But for our Bermuda-based platform, we reference the official closing auction price on the NASDAQ, for example, for NASDAQ listed securities. So we use this kind of official third-party independent benchmark provider to come up with this index that we can then base our futures on versus us doing it ourselves or base it on some kind of other price that can easily be manipulated.
I'm glad Brett mentioned manipulated, because as a podcaster, I take personal pride in being able to smoothly transition you through the wonderful world of things like perps. The question becomes, how are risks that Brett was referencing manipulated or sort of mitigated in the traditional financial markets? Traditional finance learned a lot of painful lessons over the years. There's a reason why you can't have a futures market for onions. It's a fascinating history. I'm not going to get into it. Maybe that'll be a side episode one day, but look it up if you're interested. Anyways, the lessons that were learned in the futures market culminated in the current system where we have futures and we have swaps, which I'm going to explain now. Let's get legal. I don't know. I said let's get legal. That's not going to be my sort of transition thing. Anyways, earlier in this podcast, I covered futures. Remember, barrels of oil and swaps, and these were more the financial focused derivatives for things like foreign exchange, foreign currencies. Whether perps were considered futures or swaps, these are two different things, was a massive defining question for this industry because there are key differences for both, most notably about how they are regulated, who can access them, and the amount of leverage you can offer. Perps didn't really fit neatly into either box, but historically, or at least in the previous administration, the CFTC had viewed perps as swaps. A swap is a contract where two parties exchange cash flows based on the performance of an underlying asset. So the definition of swap was added via a post-financial crisis amendment in the Dodd-Frank Act. Perps look similar to swaps on the surface, but there are three key differences. The first is pricing. With a swap, the payer and the rate receiver, sort of the two counterparties, agree on terms together of the payment, whereas perps, it's a funding rate that's algorithmically calculated in real time and sort of ongoing based on the gap, as we mentioned, between the perp price and the spot price. So they're similar, but they're different. because everyone has the same terms with perps, whereas individual contracts occur for swaps. And that brings me to the second difference between perps and swaps. That's relationships. Swaps are negotiated between, or at least the terms for swaps are typically negotiated or at least agreed upon between each counterparty, and they usually know each other. Perps are more standardized. It's the free market, baby. Every participant gets the same contract with the same terms. You don't know the counterparty, and it doesn't really matter because the third point, risks are also different. And this is where we get into the 2008 financial crisis, because swaps were probably the cause there, I'd say. So we actually have to rewind to 2008. So AIG, which is a large insurer, I'll just call them, they had written enormous volumes of credit default swaps, which are a type of swap promising to pay out if mortgage-backed securities defaulted. When those securities indeed did collapse, AIG owed billions of dollars that it did not have, and it was unable to raise the funds in time. So that meant not only did AIG collapse, but every firm on the other side of those swaps, including Goldman Sachs, was exposed to catastrophic losses because AIG wasn't going to pay up. So the US government, which to be clear means American taxpayers, intervened and bailed out AIG to prevent those counterparty losses from crushing the financial system. I hope that makes sense, right? This situation with AIG in the 2008 financial crisis led to regulators requiring a middleman, someone to help mitigate this counterparty credit risk. Now, one interesting note, though, that, to give sort of the government credit, I guess, in this case, that people don't often discuss, the Federal Reserve and Treasury committed about $182 billion to AIG across multiple programs, which is the largest, or at least at the time was the largest single company rescue in American history. $182 billion is no chump change. But the government was actually repaid in full with a net profit of $22.7 billion when AIG and the related Fed vehicles were unwound between 2011 and 2012. So I think that's true. I mean, that's what I found online. Obviously, not everything online is true, but that's a win. That's something I thought worth mentioning. Anyways, because they didn't want all this sort of counterparty credit risk to happen again, swaps were required to be cleared through a central counterparty. That central party collects margin from both sides. So they manage sort of a default fund that guarantees contract performance, even if a party like AIG was to fail again. So if AIG, let's say, defaults again, the clearinghouse absorbs all the loss from AIG using this big fund rather than letting it cascade to the other counterparties. It's a very expensive system. And with crypto, you probably don't need it. And that's because with things like perps, automatic liquidations occur, meaning you don't actually have counterparty credit risk because the margin is in something, in the case of smart contracts, or in the case of Hyperliquid, it's in a smart contract. So when the collateral sort of falls below the margin that you have set, you have your collateral automatically liquidated. And so there's not a cascading effect because in the case of traditional sort of swaps, there wasn't these automatic liquidations and counterparties didn't have margin posted sort of within this sort of middleman or third party. And with crypto, you now, and smart contracts, you can remove the need for a central clearinghouse, which is great, right? Like, that's so good. And the benefits are true regardless of whether perps are considered swaps or futures, which is why we should be tweaking these rules. Here's the chairman of the CFTC and a friend of mine, Mike Selig, who said that they were close to introducing a regulatory framework that could be fitted or would be fitted to perps. Here's Chair Selig speaking at the Milken Institute's Future of Finance conference about that.
The prior administration drove a lot of these firms and the liquidity offshore. So the perpetuals markets are a great example of this. We've had perpetual futures contracts in crypto assets for a very long time, really since the early days of the markets, but they've developed offshore. They've been on exchanges in Asia and Europe, in the Bahamas and elsewhere, and we've got to bring that back to the United States. We need to have that liquidity here in the U.S., and we need the right investor protections to ensure that these firms storms don't blow up and affect our shores. So we're working towards getting perpetual futures, true perpetual futures, not long-dated contracts here in the U.S. within the next month or so.
So before we get to a huge historic announcement and really exciting announcement from the CFTC, I want to talk about what rules apply to swaps and futures, because you need to know this to understand what's actually happened since. Swaps and futures are regulated a few different ways. The vehicle you hear about most are designated contract markets, or DCMs. A DCM is really just an exchange licensed by the CFTC to list futures. It's a legal vehicle, and it's the legal vehicle that Coinbase used to list perpetual style futures in 2025. Here's David Schaefer. He's director and associate general counsel at Coinbase, who is in the weeds on that product and explains to me here how it works.
We used a 5-year expiry and the branding of U.S. style perpetual futures because we thought that was going to be the easiest way to get the product into the futures legal structure and the market infrastructure that makes up the system. The year we attached, 5 years, is somewhat arbitrary. We picked it, we could have picked 25 or 50. We picked 5 to not box us into something that might not have a long-term product market fit. And in case, we discovered something that didn't quite work, we didn't want to be stuck with something for 50 years. Interestingly, what we're finding is that it does have good product market fit, and the year is indeed somewhat arbitrary. Now that we're live with a 5-year contract, we can do any other self-certification of 5-year contracts. I think it may require a rule amendment to the DCM's rules to list something beyond 5 years. We talk a lot internally and externally about true perps being something without an expiration date. And one of the things we're discovering is that the middle office and back office systems that connect to DCOs and other of our FCM partners, they all have a date field. And so it's a little bit of a I2K feature, right? That the technology calls for a date. And so by eliminating that, it doesn't necessarily break anything. It just adds a level of complexity to go through and fix the code, so to speak. That's a totally surmountable technology and middle office problem, but it goes beyond just what Coinbase and we can control and impacts our partners that plug into our DCM.
Now, David used a few terms that we haven't really introduced yet. And if you recall, a DCM is basically an exchange that's licensed by the CFTC to trade futures or offer futures for sale. I want to unpack some of the rules that apply to DCM so you just get a sense of why this whole regime exists in the first place. Now, if you're watching on video, you might notice the lighting's a little better today. Recorded last night till about midnight, got a bit too tired to do that, so we're doing this really early in the morning. Let's talk about DCMs. So to list a new contract, a new futures contract, what a DCM does is it's called self-certifying, meaning they attest that the product meets the CFTC's core principles and complies with the Commodity Exchange Act and CFTC regulations. So to self-certify a new product, and this is sort of a key point to understand here, a DCM attests that they have the ability to self-police or monitor for manipulation. That requires one of two things. First, a sufficiently deep spot market, so remember the market price for the underlying asset, to get the data they need through that mechanism. So for example, Coinbase uses its own spot market as reference for regulatory purposes. With Hyperliquid, as I think I've mentioned, they use a host of different exchanges, mostly Binance, but also several others to get those sort of market prices. If you're a DCM and you self-certify a contract that the CFTC later disagrees with, and we'll get into this in a bit, the CFTC can try to block the implementation of that contract. So some DCMs only self-certify with the CFTC's awareness and approval, but that's really a policy choice. Prediction markets in the US are an example of DCMs, which is going to be an upcoming episode of Law of Code. So make sure you hit the subscribe button on whatever platform you're listening to this to stay updated on our deep dive on prediction markets. As for those other types of entities that exist, so we have DCMs are sort of the main one to understand. There's also swap execution facilities, or SEFs. This is the framework for trading swaps that was created by Dodd-Frank, I believe, in 2010. Though this is mostly limited to institutional traders, we're not going to touch on this too much here. There's also DCOs, or derivatives clearing organizations, which David Schaefer had mentioned. So in 2010, Dodd-Frank gave the CFTC authority to require certain swaps to be cleared through a registered clearinghouse. Remember, they were worried about that counterparty credit risk. So these clearinghouses are called DCOs, or derivative clearing organizations, and they step in between the buyer and the seller. So if one party defaults, the clearinghouse absorbs the loss using a default fund that's contributed to by all the clearing members. As for the other parts of the framework, I believe David also mentioned the FCM of futures commission merchants, which are basically just brokers for futures and options contracts that sit between the customer, and the exchange and accept customer funds to margin those contracts. Here's David Schaefer, again, of Coinbase for a little bit more detail on DCMs. Remember, that's the exchange, how they interact with DCOs, which is the clearinghouse, and FCMs, the intermediaries or the brokers between the customers and the exchange. So those are the three moving parts. You've got the exchange itself, you've got the clearinghouse, and then you've got the entity that sits between the retail sort of customers, let's say, and the exchange itself. A lot of middlemen, as David alludes to here, when explaining how they all interact.
I've been using acronyms, but a DCM is a designated contract market. It's effectively the exchange. And at Coinbase, we have one that we acquired in 2022, was called Fair Exchange. We've rebranded it Coinbase Derivatives Exchange. It's a CFTC registrant regulated by the Division of Market Oversight and the CFTC. It lists the contracts. It has to connect to a clearinghouse. The clearinghouse that supports our margin products is NodalClear. NodalClear is not a Coinbase company. It's a Deutsche Börse subsidiary, and they've got a lot of other DCMs and customers that plug into them. So the DCO's function then is to act as the central clearing counterparty that sits between each buyer and seller of a contract that our DCM lists. Customers find their way into our exchange through an FCM, another acronym. FCM means futures commission merchant or futures broker. We have one that we built at Coinbase. We didn't buy. We built one internally, and it's purpose-built to work with our DCM. All three of these pieces have to come together before a customer can find their way into a position. So an order has to go from the FCM to the DCM, and then the signal has to go to the DCO to understand what the margin and collateral requirements are.
One of the key requirements for companies like Coinbase is compliance with the next part, and that is the anti-manipulation and anti-fraud provisions. This is sort of really the crux of the CFTC's regime here. And these touch on points that Brett Harrison, the CEO of Architect, and others have covered throughout this podcast about the importance of markets not being able to be easily manipulated or manipulated at all. These provisions are the last piece of the CEA regulatory framework, and both apply to any commodity market that the CFTC has jurisdiction over. So if you list a contract on a DCM, there are certain core principles that must be followed, and these core principles sit within this anti-manipulation, anti-fraud framework. Three of the most important core principles are in, or at least two of them are in Section 4 of the CEA. The first is Section 4B, which makes it unlawful for any person to cheat, defraud, or deceive another person. It also prohibits other intentional no-nos, sort of like making false reports, basically like an anti-fraud provision. Section 4C prohibits wash trading, which means entering into trades that have no economic substance and are designed purely to create the appearance of trading activity. Some exchanges might be tempted to do this to inflate the volume that they have traded on their exchange, for example. That point is especially important for perps, since the funding rate mechanism depends on genuine price discovery. We don't want trading to artificially push the perp price to a certain level that transfers money from legitimate traders in favor of manipulators. Then there's Section 6, and that operates similarly and makes it unlawful for any person to manipulate or attempt to manipulate the price of any contract for future delivery. Section 6C and Section 9A are the anti-manipulation and false reporting sections with criminal penalties under Section 9A. Okay, that was a lot of jargon and sort of heavy stuff, but the one thing I think that's important to understand here is how manipulation can occur and what elements are required for it to exist. So under the CEA, the Commodities Exchange Act, manipulation requires 4 elements. There are 4 things that they'd sort of have to prove. The first is that you have the ability to influence prices. The second is that you intended to artificially raise or lower the price. Third, that artificial prices actually existed, so what you attempted to do actually worked. And then fourth, you caused those artificial prices. So if you try to do all those things, but something else happens that causes those artificial prices, you might not be on the hook. But otherwise, if all four of those are met, then you could be charged for manipulation. For perps, that manipulation concern, as I mentioned, is mainly related to the pricing mechanism. If a large trader moves prices on those reference exchanges, that shifts that oracle price, which in turn affects liquidation triggers. Here's Mike Frisch. He's a partner at Croak Fairchild and spent years as senior trial attorney at the CFTC to explain more on the importance of the oracle price.
Here it's a different mechanism, right? There's no expiration to force conversions. Instead, you have this funding rate. And I think it's performed pretty well. I'd love to see data over time. But at the end of the day, it's all like with any financially settled derivative, it's only as good as the oracle price. And so when you have a perp that's like defined, it's based on like a very robust oracle, like Bitcoin traded on big exchanges, I think it works pretty well. But when you have a perp that's like the Mango Markets one or some other thinly traded product with a poor spot price oracle, then you can have, it can lead to all kinds of problems.
I'm glad Mike mentioned Mango Markets because my favorite thing to do as a podcast host is to make a smooth, natural transition between talking points. And I know I just ruined it with this comment, but let's pretend I didn't. So yeah, Mike just mentioned Mango Markets and all kinds of problems with potential manipulation. To understand that and sort of how those problems play out, we need to rewind back to 2016, which is 10 years before I recorded this podcast. And that's because 2016 is when perps really started en masse in the crypto industry and really in the world in general. So in 2016, a company called BitMEX popularized the crypto perp. And by doing so, proved that the funding rate mechanism worked at scale. Arthur Hayes, one of the founders, deserves a lot of credit for that. And if you recall, that funding rate is sort of the fee that the parties pay to hold a position above or below the spot pricing. Because perpetual futures weren't really offered anywhere at scale at that time in the world, and the rules weren't really clear, exchanges like BitMEX weren't registered with any regulator like the CFTC and began to offer these products to retail traders with enormous amounts of leverage and weren't really checking for things like anti-manipulation provisions. But the demand was huge. BitMEX exploded in popularity, and by 2018, they were trading over $1 billion in notional volume every day. Then the CFTC stepped in a few years later. On October 1st, 2020, the CFTC and the U.S. Department of Justice filed parallel charges against BitMEX and its founders. BitMEX eventually settled by paying a $100 million fine, and the founders settled separately. Wait a second, right? The CFTC is involved here. If you recall, that's the Commodity Futures Trading Commission, which regulates both swaps and futures, those financial instruments we've talked about. As I mentioned earlier, though, this rules that the CFTC follows comes from the Commodity Exchange Act, the CEA, which requires that derivatives be traded on regulated exchanges if they're offered to U.S. persons or have some nexus to the U.S. The question, though, was, what were perps? Were they swaps? Were they futures? Like, what was it that tied them to the CFTC? What gave the CFTC authority under the CEA to go after an exchange like BitMEX? It really wasn't clear. And with the recent announcement that we've got from the CFTC that says certain types of perps are futures, we've now got sort of differing interpretations. And let's explain that now. So the CFTC had historically viewed perps as swaps, or at least they used that interpretation as a way to go after exchanges like BitMEX. And we've talked about swaps here. It's a contract where two parties exchange cash flows based on the performance of an underlying asset. The definition of swaps is actually new. It was added after the 2008 crisis via the Dodd-Frank Act. And I'm going to explain that more in a second. Now, we've got five. We've got 5 examples of cases where the CFTC went after businesses offering perps, alleging that those perps were swaps. So in 2020, as you know, the CFTC sued BitMEX, who had marketed its perp as a product similar to a traditional futures contract. And a court found that BitMEX had solicited and accepted perpetual swaps or perpetual contracts on Bitcoin, Ether, and Litecoin, and BitMEX settled this. In 2023, the CFTC sued Binance, and in that complaint, the CFTC literally says, quote, Binance's perpetuals are swaps. Binance settled that case. In 2023, we also saw the CFTC sued the company behind the Deridex protocol, which is a perpetual or was a perpetual contracts trading platform on the Algorand blockchain, alleging that, quote, respondent operated a trading platform designed to facilitate the trading of perpetual contracts, which are swaps under Section 1A47 of the Act, is what the order of settlement stated. In 2023, we have that Mango Markets case involving Avi Eisenberg, who was charged with fraudulent manipulation to unlawfully obtain over $100 million in digital assets from a platform that traded perps. In the CFTC's complaint, they refer to Mango Markets perps as meeting the definition of swaps. That's on page 7 of that complaint. In 2023, the CFTC also charged and settled with Deridex and Open for offering perps, again referring to them as swaps. Here's Mike Frisch, a partner at Croak Fairchild and a former CFTC trial attorney, explaining why it was a bit confusing here.
There actually is no definition of a futures contract in the Commodity Exchange Act itself, which is a little bit strange. But so I think the closest thing is the swap definition. So it's 1A47 of the Commodity Exchange Act. And there's a multi-pronged definition of swap. And, I think that the perps model with the funding rate, where you have funds programmatically being exchanged from one side to the other, depending on how far away it is from the spot price. I think that's probably the closest. I'm trying to recall, maybe you know, Jacob, whether in any of those settlements or in the enforcement action, if the CFTC actually identified which subpart under the swap definition it was relying on. I don't believe that it did.
That's interesting. Yeah, let me check. I've got a complaint. I've got the complaint up in the Eisenberg case. Here it is. Yeah, they do 47, 1A47.
Yeah, so they were preserving, I'm looking at paragraph 51 of the complaint, the Avi Eisenberg complaint. That's called preserving optionality when you're when you're a lawyer. Yeah, that's what they were doing here.
The main takeaway that's important to keep in mind here is that the CFTC has claimed that perps are swaps in lawsuits, but it really wasn't clear, at least until 2 days prior to me publishing this episode, when the CFTC made a landmark announcement. More on that in a few minutes. And stick around for that because it really, really is important. Now, as I mentioned, the CFTC basically shut down BitMEX. Ryne Miller, who's been a guest throughout this podcast and is a partner at Morrison Foerster, used to work at the CFTC. Here he is explaining what happened after BitMEX.
When BitMEX got hit by regulators for the different violations that they got hit with, it created an opportunity for a new exchange to emerge that had arguably solved some of the auto liquidation and auto deleveraging issues with different types of risk environments and different types of default waterfall funding.
That exchange he's alluding to is FTX, which emerged shortly after BitMEX shut down. FTX quickly became one of the largest centralized crypto derivatives exchanges in the world. Perps were a major part of FTX's offshore offering. Here's Ryne, who explains why he joined FTX's US arm and the main reason why FTX's perpetual futures product was offshore.
From a product perspective, getting perps into the United States in 2021 was probably too forward thinking. And I think no one was optimistic it was going to happen then. I believe there's not a statutory reason that perpetuals can't be offered in the United States now. The CFTC is governed by the Commodity Exchange Act. That's a statute adopted by Congress, amended from time to time. I can't find anything in there that says perpetuals, if they're listed on a CFTC venue, should not be permitted.
Now, we'll talk about more on that point in a few minutes. For now, I just want to quickly note that perps were not the reason why FTX collapsed, not at all. It wasn't the amorphous industry of crypto either, nor was it their US-based business. Like Enron or countless prior examples, theft and fraud was to blame, specifically from people at the top. Sam Bankman-Fried was sentenced to 25 years in federal prison for orchestrating one of the largest financial frauds in history. And that's really what it was. I think what's important to remember is that if there's any lesson we shouldn't forget from the 2008 financial crisis, it's that even the compliant blue chip companies can commit fraud. But it's a lot easier to find that out when a business is onshore, which is why I'm making this podcast, so regulators can understand these technologies and make rules to accurately and properly address the risks, rather than have regulators ban these products because they don't understand them and they react out of fear. People fear what they don't understand. This stuff isn't rocket science, though, so please share this podcast so that others can learn about this technology, this financial innovation. That's all I ask. Just share it with one person, or better yet, on your social feed. Thank you. Anyways, after FTX collapsed, the free market responded with new products. And the crypto industry, again, recognized the risk of giving up custody over your assets to a third party, because FTX was a custodial exchange, meaning people handed over their assets or their collateral to FTX and trusted it to hold it safely. Blockchains offered a solution here, a better way to operate, I would say. I'll use Hyperliquid as an example of a blockchain-based non-custodial product, since they are the most well-known perp platform, and similar blockchain-based products work similarly. So as mentioned, Hyperliquid is a non-custodial perpetual futures exchange that uses its own purpose-built blockchain, which as of mid-2026 holds roughly 70% of the open interest in decentralized perps trading. How does Hyperliquid work? Well, it's pretty simple, actually. You'd connect your digital asset wallet to Hyperliquid's front end. So if you're not in a geo-blocked location, you'll go to their website. You'll connect your wallet. When you're at their website, you'll deposit USDC with them. And once your USDC is on Hyperliquid's L1, which is just another way to say their blockchain, you start trading the perps. So in other words, you sign in, deposit, and start trading. But let's get a little bit more technical. If you don't want to get technical, you can fast forward about 5 minutes and you'll get back to sort of the legal side of this. Otherwise, strap in. So when you deposit USDC on Hyperliquid, you are moving that USDC into a bridge smart contract that lives on Arbitrum. Arbitrum is an Ethereum layer 2, which is a separate blockchain that sits on top of Ethereum and inherits its security. Now, layer 2s exist to batch up thousands of transactions, process them cheaply on their own network, and then periodically post a compressed summary back to the Ethereum blockchain. The result is similar security guarantees as Ethereum, not exactly the same, at a fraction of the cost. And that contract address, you can actually see, I'll put a visual, if I remember, on the screen now. Your USDC sits in that contract. It's not held by anyone at Hyperliquid. It sits on that contract. Now, the Hyperliquid L1, Hyperliquid's purpose-built blockchain, then credits your account. So it recognizes that transaction on Arbitrum, credits your account, and then you trade perps on Hyperliquid's blockchain, so long as you're not in a geo-blocked location. So your USDC is in the contract while your trading is done on a different blockchain. What's amazing with crypto is that you can see all these deposits happen. It's available for free on the Arbiscan website. When a user initiates a withdrawal on the Hyperliquid L1, the validators collectively sign the request and then submit the finalized transaction to the bridge contract to release the USDC back to the user's destination address. It's a lot of jargon, but really all you need to know is that unlike FTX, which had an internal ledger that it could conceal from all of us, even internal employees, the flow of USDC on Hyperliquid is publicly visible on a block explorer that anyone can access without permission. How great is that? Anyways, you get the benefits of the perps without really losing sight of your collateral. Now, one thing that I think is important to know is that bridges and contracts like this often use an upgradable proxy design. What that means, without jargon, is that there's basically an administrator, a central party, someone who can change the underlying contract. And in the case of Hyperliquid, that admin key is controlled by the Hyperliquid Foundation using cold wallet custody. The Hyperliquid Foundation is a nonprofit style entity that acts as a steward of the protocol's governance and ecosystem development. So Hyperliquid Labs, through the foundation, can work together to upgrade the bridge contract where users' funds are held. This is standard industry practice, and it's really a good thing. We want these systems to be able to improve. Now, obviously, there's a downside to that. It also means the rules governing how your USDC moves in and out of Hyperliquid aren't fixed. They can be changed, and that's probably another area where we need regulation to reduce risk to users. It's a bit different from a protocol like Bitcoin, where changes require sign-off from the distributed network of nodes and miners. There is no admin key to upgrade Bitcoin. What's crucial here, though, is that someone like SBF, Sam Bankman-Fried, can't decide to reach into the bridge and take your USD arbitrarily, or at least if he tried to by updating the smart contract, any malicious upgrade would be visible immediately on-chain, so we'd see it happen in real time. So as you're probably getting the sense, these are some enormous improvements over the traditional financial system in ways that make everything better for everyone. But there are still minor areas to address and important risks to be mindful of. Now, until 2 days prior to publishing this episode, we didn't have much from agencies like the CFTC on perps beyond certain positions that they'd taken in court cases during a regulation by enforcement era. The sentiment that perps were swaps wasn't universally agreed upon by all the experts that I spoke to. The practical result, though, of the CFTC's prior approach was that Americans were forced to exit the country and geo-block US IP addresses at the front-end level. So for Hyperliquid, for example, the protocol maintains the position that it is a decentralized blockchain with no legal personality. Hyperliquid Labs, the software contributor behind Hyperliquid, is incorporated in Singapore. Now, that said, there have been cases involving offshore perps trading where the CFTC still claimed jurisdiction even though geofencing occurred. We won't get into the merits of that. I only raise it to say that it's an important question ripe for debate and is a future Law of Code episode on the question of jurisdiction in the internet age, so subscribe for that. Really, it's not clear exactly what a protocol needs to do to stay out of the US, but there are steps they can take. Architect, for example, is based in Bermuda, and its CEO, Brett Harrison, explained to me his thinking on why they incorporated in Bermuda.
So more than 2 years ago, we as a company took a look at the explosive growth in perpetual derivatives in digital assets and just believed that it was only a matter of time before the general public got educated on what a perpetual was and understood that this would be a fantastic derivative product for people to be able to get their normal, just cash exposure to whatever the underlying asset is. They don't necessarily need to take delivery. They just want the economic exposure. But we also had this thesis that, the futures market globally is something like anywhere between 5 and 10 trillion notional traded per day. That's not retail accounts. Those are enormous institutional accounts. They're giant macro hedge funds. They're sovereign governments, sovereign wealth funds. That's who's trading these futures. If we're going to introduce perpetual derivatives on traditional assets and get that capital allocated towards those derivatives, we need it to be properly regulated from the very beginning. This needed to be like a fully AML, KYC compliant exchange, with the typical risk management that you would see on like a CME. And so, we took the hard and slow path of getting regulated. First in Bermuda, we got 2 licenses out of Bermuda, and we just got those licenses at the end of last year. We just launched our exchange a couple of months ago. It's been our thesis that in order for us to really reach the institutional masses, we had to be regulated from the very beginning. And we're starting to see the proof that was the right way to go for us.
Projects like Architect, Coinbase, Hyperliquid, and many others seem intent on figuring this out the right way. Hyperliquid, for example, formed the Hyperliquid Policy Center. They hired a prominent lawyer and policy advocate in Jake Chervinsky as CEO, and they're engaging with regulators in the CFTC for potential rulemaking. Jake and his policy counsel, Brad Bourque, who I later learned was a former offensive and defensive lineman, like a Travis Hunter type at Princeton, shout out to Brad, joined me to answer some of the questions at the end of the podcast I had around Hyperliquid, how they operate, and what rules we need to mitigate risks here. You can find that near the end of this. There's a link and a timestamp in the show notes about when that interview begins if you want to just jump there. But I think you should stick around because arguably the most important part of this podcast is coming up next. And honestly, it's kind of historic and breaking news if you're listening to this in 2026. Yes, we've got a historic announcement from the CFTC just 2 days before I published the episode. And if anyone from the CFTC is listening, can you guys give me a heads up next time so I don't have to work all weekend to get this out? Anyways, this moment was a long time coming. We can go back really to April of 2025 when the CFTC, led by former acting chairman Caroline Pham, published a request for comment on perpetual style derivatives. It was essentially the CFTC admitting that, hey, proper rules should be drafted for this industry. The request asked industry participants to help the agency classify perps and address their risks, and they received 157 responses. Now, Architect, the licensed and custodial platform that is and calls themselves, quote, the first centralized and regulated exchange for perpetual futures, also filed a comment letter, though it took Architect CEO Brett Harrison a few times to upload it. I went through his filings. There were 3 of them. The first 2 were blank, but the third one had the actual comment letter in it. And as someone who has sent countless attached emails without any attachment, I feel for Brett here. And of course, I had to call him out on it during our interview because we have fun here. Here's Brett to explain himself.
There was like a technical error at the time with the comment submission, and so we kept submitting, saying, "Oh, it wasn't showing up." Either
Yeah,
that, or
I was like, oh, this
really,
must have been.
really eager about perps. We wanted to submit 10 times.
Anyways, because perps do not fit neatly into futures and swaps definitions, Architect recommended that the CFTC answer 6 main points that I'll put on the screen here, but we don't need to get into in detail. Architect and Hyperliquid basically made the similar points over perps being better than dated futures on 2 key points. The first being no liquidity fragmentation. Remember, everything can be in one financial contract, whereas with dated contracts, you have these sort of different expiry dates and liquidity sort of spread out. There's also no roll risk or cost. So traditional futures require traders to close positions and open new ones if they want to stay in it, whereas perps don't need that. Hyperliquid also told the CFTC that it already satisfies the core things that they care about, and in some ways do it better than traditional venues related to things like transparency, market surveillance, consumer protection, and automatic liquidations. Now, projects like Hyperliquid and Architect are not arguing that they should be exempt from oversight. They, just like all of us, want the CFTC to write principles-based rules that recognize and allow a novel technology to exist. When can we get rules? Well, we kind of actually just did. Now, CFTC Chairman Mike Selig, who is a really great guy and working his butt off on all this, as are the rest of the staff at the CFTC, Chair Selig has said that they were close to introducing a regulatory framework that would be fitted to perps. And speaking at the Milken Institute's Future of Finance conference a few months ago, or weeks ago, I'm not sure exactly how long ago it was, but Chair Selig hinted that rules were imminent. Now, what could the future look like? Before we talk about the immediate short-term results we've seen from Chair Selig and his team there, here's Mike Frisch, a partner at Croak Fairchild and former CFTC senior trial attorney who recorded with me prior to the big news that I'll explain next. Mike sort of talks about what he thinks the first steps will look like, and he kind of got it exactly right.
You know, I think the first step is going to be some DCM will incorporate aspects of decentralized, blockchain-based settlement, and from there it'll grow.
Oh.
So the CFTC, the Commodity Exchange Act, has broad exempted authority. And typically when people saw transitions, for example, from floor trading, like we all saw with, Eddie Murphy and, trading places to electronic trading, the progression there was, it started with, action letters and requests for exempted relief, which then led to changes in rules and changes to the actual statute. So I think that's where we're at now. And I know there are a number of startups that are in discussions with the CFTC about how they can incorporate a blockchain-based settlement into their products. So I think we'll see more of that in the near future for sure.
As I said, Mike is right here. So on May 29th, a Friday of 2026, the same day that David Schaefer of Coinbase's son won his Little League World Series, shout out, the CFTC made 4 announcements of historic proportions, at least for this nerdy and valuable corner of the world. We were all really, really excited. So at a high level, there's 4 things that happened here on Friday, May 29th from the CFTC. There were 4 sort of announcements that they released in parallel in this order. First, they released a staff advisory regarding 24/7 trading, clearing, and settlement in the form of a 12-page letter. Then they released an order approving Kalshi, which is a prediction market. We'll talk about at length in the prediction market episode, but more in a second. The second one was an order approving Kalshi's DCM listing a perpetual contract for Bitcoin, which was designated importantly as a futures contract and not a swap. The third announcement was an interpretation and a no-action position allowing Coinbase to offer perpetual contracts traded on Deribit as foreign futures on Coinbase's FCM. So we've got the DCM for Kalshi and the FCM for Coinbase here. The fourth was a policy statement that I think reassured the rest of the non-crypto industry that, hey, this isn't going to happen for everything. Basically, the policy statement says that a case-by-case review is needed for assets that weren't contemplated by the order. It's a short document, but it's a framework that explains how the agency intends to handle perps going forward beyond just Bitcoin. Let's dive into the 2 sort of most substantive parts of this, which is Kalshi's order and Coinbase's no-action letter. So Kalshi's order was the first example I've seen of the CFTC formally approving onshore perpetual futures contracts in the US in history. The product is the BTC perp contracts, a perpetual contract that references the spot price of Bitcoin calculated against a benchmark price of Bitcoin. This trades 24/7. It has no expiry date and uses the funding rate mechanism to maintain price convergence with the spot price. It's the same mechanism, or a similar mechanism at least, that BitMEX pioneered in 2016. Now, the commission categorized this Bitcoin perp as a futures contract under the Commodities Exchange Act. And in their order, they walk through the case precedents to conclude that indefinite duration does not disqualify a contract from being a future so long as it has other hallmarks of futures, that is standardization, fungibility, clearinghouse guaranteed obligations, and the ability to exit by offset. Importantly, the commission limited the order to Bitcoin and this is a contentious point among lawyers, but this is my reading of it, the commission limited the order to Bitcoin and similar digital commodities with deep, broadly distributed, continuous spot markets. They explicitly flag that the analysis does not extend to agricultural products, equity securities, or other asset classes. As I said, there was some debate by legal experts over whether this decision was limited to Bitcoin perps or if Kalshi could self-certify. Remember, this is the process of a DCM self-certified and basically approving themselves to offer different types of contracts. You tell me what you think based on what the order exactly says. Here's the quote. Quote, contract categorization analysis is done on a case-by-case basis, and the analysis in this order is, therefore, limited to the BTC perp contract and similarly structured perpetual contracts that reference the spot price of Bitcoin or other digital commodities that have deep, active, and continuous spot market trading. Unquote. Now, that's directly from the CFTC's order. Sounds to me like digital commodities with similar characteristics to Bitcoin. Now, there aren't many of them, but they would be available for Kalshi's DCM to approve, to self-certify, because the order says literally exactly that. Now, if you've listened this far into the podcast, you're going to appreciate this regulatory detail. The order is issued under the voluntary product approval process, which is distinct from the self-certification path. So what Kalshi did here was they sought a formal commission approval rather than self-certifying. And as a DCM, you can self-certify, but this was the more cautious path and produces a more durable regulatory record. Now, as for the Coinbase order, well, the Kalshi side is perps can be onshore futures. This Coinbase letter is a bit different. It's basically saying that U.S. customers can legally trade offshore perps through a regulated U.S. broker. Thankfully, Coinbase's David Schaefer was again very generous with his time and connected with me on a Sunday morning to explain this.
Our relief is different than Kalshi's. Our letter permits routing U.S. customer orders to a foreign venue via a foreign futures and options broker. This is a decades-old framework that's existed under Part 30 of the CFTC rules from the 80s. Essentially, in our relief and Kalshi's relief is that perps can be a futures contract if there's a deep, broadly distributed, active underlying spot market. So that's a check.
Now, as David is about to add, the letter clears the path for Coinbase to accept Bitcoin, Ether, and other digital commodities plus regulated stablecoins as margin collateral from U.S. customers and transfer those assets to its Bermuda-regulated foreign broker affiliate, which can then post them to Deribit. This is a really important wrinkle that David Schaefer of Coinbase is going to explain.
With our letter, we also got the ability to transfer digital collateral with the right of reuse to a foreign venue. So with our relief now, we can use our US regulated FCM to connect US customers through a foreign futures and options broker that can take crypto collateral and transfer it to the foreign venue without having the foreign venue being registered. And that's an essential element to pre-funded perps markets working fluidly. This is the really interesting feature. International markets have developed ahead of the US, and by and large, international derivatives, crypto derivatives markets require pre-funding. So with our relief now, we can connect a US customer that can have their crypto natively, not fiat, flow through our own foreign futures and options broker, and existing deep perp markets.
What was the reality before this? Just for people to understand. And we've sort of talked about it a bit before, but like walk me through why this is such an unlock. Was it not possible to route orders through Deribit prior?
Yeah, that's correct, Jacob. So Deribit's not registered in any capacity with the CFTC, and they're not required to be. Unless we provide direct access to Deribit, they're not required to be a registered foreign board of trade. Direct access to U.S. persons. So before this relief, we don't really have a way of connecting U.S. customers directly into Deribit.
Now, as for the final document, that fourth document we got from the CFTC, that's just a policy statement. Because of the complexity here, I think it was a really wise decision for the commission to put out their position that perps on asset classes not contemplated in the order, meaning asset classes other than digital commodities with deep, active, and continuous spot market trading cannot be self-certified under Regulation 40.2. That's the self-certification reg. So if you're doing a different type of asset, you have to go through that sort of slower formal approval process under Regulation 40.3. So again, I think it's possible for a DCM like Kalshi to self-certify other digital asset classes beyond Bitcoin. ETH is probably the most obvious next one, Solana, and many others. So it's really exciting times. And I think this comment from David Schaefer of Coinbase covers that well.
I mean, the perp market globally, as you've noted, are multi-trillions in volumes, multi-billions in revenue, super popular around the world. And until now, U.S. customers have largely been locked out of accessing those markets through regulated means.
And while these updates are incredible, they don't cover everything, specifically not projects like Hyperliquid, which offers purely on-chain perps on a non-custodial exchange. Now, I'd like to think of this next part of the podcast as sort of the keynote, a fireside chat with Hyperliquid Policy Center's CEO, Jake Chervinsky, and policy counsel, Brad Bourque. They were exceptionally generous with their time and answered every question I asked, finished the conversation convinced that this team wants to do it the right way, similar to everyone else on this podcast, which is particularly important given how difficult some of these questions around Hyperliquid's offering truly are. Again, thank you so much for listening so far. I think you're going to enjoy this interview tremendously. It's a really fun one. I learned a lot from it. Brad gave some incredible examples of problems that have existed in the traditional futures space, and I expect you're going to enjoy this as well. Just a note, though, we did record it prior to the CFTC's landmark announcement. Anyways, here's your fireside chat with Jake and Brad of the Hyperliquid Policy Center. Jake, Brad, thanks for reviewing the script that I had prepared beforehand and for taking the time to join me.
Thanks for having us. Great to be here.
Yeah, happy to be on.
So I want to start with Hyperliquid's American founders. Jake, I believe it was you who tweeted that they had been driven out of the country by the prior administration's war on crypto. And when I always think about the U.S. as a Canadian myself, to me, the U.S. is a place that was built by people, by ideas, right? By people wanting to be in the country and by freedoms. When we see things like this and we hear things like this, it seems like we're going in the opposite direction.
I think that's true. And I think that the Hyperliquid Labs founder's story is very similar, unfortunately, to many other developers in the industry. These are two Americans who met when they went to Harvard, had productive careers in the United States, decided that they wanted to build a crypto company, but they decided to build it during the Gary Gensler era, when the Biden administration and many other regulators, in addition to the SEC, were really targeting crypto developers for persecution through a campaign of regulation by enforcement, and then even criminal prosecution, where the government had never before explained that conduct these developers were carrying out could ever be subject to federal criminal law. And the Hyperliquid founders decided that they just didn't want to take on the risk of being subject to regulation or prosecution for totally innocent and productive conduct. So they decided to leave the country, and they built Hyperliquid Labs in Singapore, a jurisdiction that historically has taken the exact opposite approach of the Biden administration and regulators like Gary Gensler, who were really very welcoming of this type of innovation. And so Hyperliquid Labs has been working offshore ever since its founding. In addition, the product is not available for access here in the United States because the laws and regulations are still not updated to allow Americans even to access this type of new technology. And that's in many ways why the Hyperliquid Policy Center exists, to try to change the law so that we can onshore these types of products and make sure that developers can build and innovate and create the next generation of financial infrastructure here at home.
Yeah, I would just add too, there was a lot of uncertainty related to perps in particular, and perps like we see them now, but also other perpetual style instruments, things like leverage tokens and whatnot. And we saw enforcement from the prior CFTC, both in the centralized context, looking at exchanges like BitMEX and Binance, and then also with respect to DeFi protocols, with a few enforcement sweeps that we saw involving Open, Diradex, Uniswap. So both from a macro perspective on regulation by enforcement and more granularly in the derivatives world, it really just was not a conducive environment to innovate at the time.
And I want to talk, just to get a little personal for a second, I want to talk about why both of you joined the Hyperliquid Policy Center. Just because I think so many times we forget the humanity of what's actually happening here, especially when it comes to technology and breakthroughs and stuff. Like, these are people who are building these things. These are people who are using these things. These are people who are benefiting from these things. You both are people who are working for a particular reason. And I know Jake, I've known for quite a few years. Brad, we met on this podcast, but I've seen the work that you've done before and heard of you. And so I want to know, Jake, what brought you to the Hyperliquid Policy Center, and what was it that motivated you to join?
Sure. Well, I had the pleasure of meeting Jeff Yan, the founder of Hyperliquid, a little over a year ago. And honestly, I was just blown away, not only by the project that he was building, but also by him as a person and as an executor and as a person of really high integrity who, as I said, had been driven out of the country because the laws and regulations here were not welcoming for developers like him. And in many ways, I've dedicated the better part of the last decade of my career fighting for developers just like Jeff to build the future of finance using public blockchains. And at the same time, I've seen a lot of DeFi projects come and go during my time in crypto. And Hyperliquid really struck me as the most exciting that I've seen in all of those years. Hyperliquid is a product that people want to use, not because they are ideologically aligned with crypto libertarian anarchism or something like that, which is wonderful, and many of us do hold views like that. But people want to use Hyperliquid because it is just a better product than the traditional financial system can build. And so to see the United States getting it wrong to the point that not only is the product not available here, but an amazing entrepreneur like Jeff can't build his company here, I felt like the highest and best use of my experience and my skills and my time was to help change the laws and regulations so that Hyperliquid and other decentralized markets and other perpetuals, derivatives, and products like it can be built and offered to Americans. And so after a fair amount of time talking to Jeff and his co-founder about what it would look like to engage in Washington, whether there is an opportunity now with the Trump administration and Chair Atkins at the SEC and Chairman Selig at the CFTC, an opportunity to really make an impact, I decided that this was a challenge that I couldn't pass up. And I'm really proud and glad to be leading the Hyperliquid Policy Center now.
Yeah, it's funny how it almost becomes a moral imperative in a way, because if you see something new being built and you see really smart people building it, and rules are being tabled that scare them away or get them out of the country, like, that is a slippery slope. And if that continues, and it might start with one sector but then continues to other areas of finance, next thing you know, we're living in a world where the things that you want to be built in your country are being built elsewhere en masse. And so I can definitely understand the imperative there and the importance there. Brad, don't want to, didn't mean to set you up. You have to have some grand reason as well. But I think it's really important to just talk about the human side of it. Why did you join HP?
Yeah, definitely. So aside from all of the great reasons that Jake laid out about how great Hyperliquid is as a product, I spent the last 2 years at Sullivan & Cromwell, primarily in the commodities and derivatives practice, working with a range of TradFi and DeFi clients operating in this space. I spent a lot of time working with prediction markets in particular prior to kind of like this full wave of litigation we're seeing. And I was just really drawn to working with the Commodity Exchange Act and in the derivatives regulatory space because of just how innovative the space can be. and how the frameworks and the rules are designed to accommodate innovation, and they have grown with the markets, over the course of the last century. And then looking out into the market and seeing how successful Hyperliquid has been, and really kind of, the paradigmatic example of what's possible when we bring financial markets on chain fully was just so exciting. Like it was just an opportunity that I couldn't pass up. And so when Jake came along, I just knew that, this is where I wanted to be spending the next part of my career, working towards the important work we're doing here at HPC.
And for everyone listening, I mean, how great does Brad's microphone sound? Whatever you've got as a mic there, Brad, is fantastic. That quality is great. I want to talk about the benefits of perps compared to futures and swaps. You've sort of alluded to that, both of you there, and how this is a novel financial product that's important. And I'm sure when you guys are talking to people in TradFi about perps, there's a lot of misconceptions. So what are like the 2 or 3 core things that you tell them for why this is a, let's say, alternative to what's existing?
It's a great point that perps are better for many use cases, although not for all use cases. But for many users or traders of derivatives, a perpetual derivative is fundamentally better than a future or an option or a swap. And the reasons for that are a few. One is that a perp, unlike a future or an option or most swaps, very closely tracks the price of the underlying asset. So when you're trading a future or an option, it's often very hard to understand dislocation between the price of the derivative and the underlying spot asset. And that's complexity that most traders don't want to deal with. The perp is very closely tied to the price of the underlying. The perp is also, in almost all cases, significantly more liquid than another type of derivative. And the reason for that is because it is perpetual. It doesn't expire. So whereas with futures or options, you have many different markets with different expiries with the same underlying asset, with a perp, you have only one market for the asset. So all of the liquidity gets concentrated. And of course, in the derivatives markets, the depth of liquidity is one of, if not the most important factors in determining the efficiency and the strength of the market. And then lastly, I would say for most traders, perps are just way simpler. They're much easier to understand. I've been around trading for a very long time. I still cannot explain to you what the Greeks are or how to value an option. And most people, frankly, should not be options traders. And so in a world where we're seeing a huge amount of speculation and trading in zero data expiry options, a lot of those traders are better served by a much simpler product like perps.
I would just kind of add it. There are some real operational frictions that perps remove from the market from a trader's perspective. When we're thinking about like dealing with roll dates, for example, when you do have expiries occurring in the dated futures market, there's been operational complexity to that. These tend to be volatile times in the market where trading firms, have to have their compliance desks on standby. They have to have their trading desks, manually staffed during this period, making sure that the roll goes smoothly. And there's also a real economic cost that firms can incur when they're rolling dated futures. And there's a good example from the 1990s. There was a German energy firm that had these long dated 10-year physical delivery oil obligations, and they were trying to hedge that exposure using short dated futures instruments. But just because of the way the market conditions were at the time, it was becoming increasingly expensive for them to maintain that exposure. So every time their contract was expiring, they were having to exit the position and then purchase a more expensive contract at the next tenor to move over. And so over time, they ended up realizing over $1 billion in losses. The parent company got involved, took off the hedge, unwound the positions. And there's been a lot of academic debate about whether they had a good hedging strategy from the get-go, whether it would have worked over time. But I think the broader point is just that, not that perps would have been the solution that would have saved this one firm, but it would have been another tool in their toolkit. And I think that the market participants are always better off when they have more tools at their disposal to express views about, prices in the market and take and manage price risk.
Jake, no wonder you gave Brad a call. That was a fantastic example, man. Like, what a good way to illustrate one particular specific problem, right? Like if you're that company and you've lost $1 billion, no positive economic activity has resulted from that. It's just the friction in the market and the existing products. And so perps solve that issue perfectly. So that makes a lot of sense. But one thing I think where some issues come into now in the US is rulemaking, right? If perps are going to be onshored, we got to figure out, are they swaps? Are they futures? How are they going to be traded? Do you need a DCM? Like there's so many questions that I've explained or walked through in the podcast prior to this interview. But I want to hear, like, where are things at in terms of rulemaking with the CFTC right now? I know that some common letters, and we've talked a little bit about the Hyperliquid Labs one. Where are things at with rulemaking when it comes to perps?
In progress. And I think we have to divide this into two different categories. The first being perps that trade on already registered traditional centralized exchanges, and then separately perps that trade in DeFi protocols or through on-chain financial infrastructure like Hyperliquid. And on the centralized perp side, I think that the CFTC is very constructive on providing guidance so that it's clear when and how a DCM can list a perp and allow it to trade in a retail-facing environment. We've heard Chairman Selig speak at a couple of different public events where he's explained that he understands the benefits of perps and that they should be tradable on a DCM. He describes them as perpetual futures in that context. And so I think it's likely and certainly something that would be beneficial for the market and for the country for the CFTC to come out with some guidance based on what Chairman Selig has said publicly. But I do think that that's the low-hanging fruit. That's the easier lift, because perps are derivatives that can be characterized and self-certified on a traditional exchange. But as many listeners will know already, the Commodity Exchange Act mandates that basically all derivatives trade on a regulated intermediated exchange. And in the Hyperliquid context, just like in all DeFi or on-chain financial infrastructure contexts, there is no way to register a public blockchain like Hyperliquid as a designated contract market. And so the CFTC is going to have to do a significant amount of additional work to figure out what does it look like to have regulated perps that trade off exchange in a decentralized environment. Our view at HPC is that the CFTC has all the statutory authority that it needs in order to do that work. But it is very difficult work. This raises a whole bunch of really thorny issues that folks in the DeFi space have been wrestling with for many, many years. And all of those will show up in the rulemaking that we hope that the CFTC will do. So I think that will take some time, as all good things do, but we're very hopeful and optimistic that the CFTC will get there hopefully pretty soon.
Yeah, and I want to talk about those risks and what makes Hyperliquid unique and the DeFi aspect of it. But first, just to rewind a second, I know there have been CFTC enforcement actions which have sort of claimed that perps are swaps. Why can't we just say, okay, perps are swaps and we'll operate accordingly?
Yeah, so happy to kind of dive in there. There's actually a good case from Easterbrook in the Seventh Circuit, looking at some complex derivatives products a while back, and he has a famous line that we're trying to decide whether tetrahedrons fit into square holes or round holes. And I think that that's really true when you look at perps as well. They do have characteristics of both futures and swaps. And to your point, in the prior enforcement actions we've seen the CFTC take the position, both in the centralized context and in the DeFi protocol context, that perps can be swaps. But we've also seen other cases with perpetual style instruments where they've said that they're leveraged retail commodity transactions, which are treated as if they are futures under the CEA for purposes of the exchange trading requirement. So there is a lot of ambiguity. And to kind of add to that too, if you recall the Mango Markets Eisenberg manipulation action, one of the instances the CFTC referred to perps as swaps, the parallel SEC complaint at the time also called them futures in that complaint. So we really do have a mixed bag of precedent, which is difficult for market participants because in the derivatives world, so many of the other regulatory obligations flow downhill from that product categorization standpoint. It dictates where they can trade, who can trade them, who has to register as what the reporting requirements look like, how margin is calculated. So there's really a lot of downstream consequences from product characterization that we think that either guidance or rulemaking from the CFTC in the near term can really help answer a lot of questions and show participants a path forward to bringing these markets to the United States.
Thanks, Brad. And I think one thing too that your answer points to, and I'll just rehash as well, is that there's also the risks that you want to address, right? Like you're not saying give us, a get out of jail free card for whatever we do. You're saying let's just tailor some rules in a way that makes sense. Much like when the automobile was invented and popularized and manufactured en masse for people, they created rules for cars. They created speed limits and stoplights and ways to make it accessible to the market wanted it. So they found a way to make it accessible for people. It's not easy to do. As Jake said, it's going to take a lot of work. And some of the things that they're going to need to work on are what I want to talk about now, some of the risks that they're probably thinking about. And one of those is undoubtedly, like with any derivative, the price anchor. And in the futures markets, there was always that timeline where you knew at some point there was going to be deliveries. So as it got closer to that date, the price was a little tighter. Perps rely on financial incentives, not the delivery date. That actually, and as you've said, Jake, that actually might be stronger than typical futures in terms of the power of the price anchor.
Yeah. I mean, with dated futures, we have the price anchor in the form of convergence at the expiry date, which is then tied to some pretty complex delivery economics that factor into that about physical storage and things like that when you're talking about agricultural commodities or certain energy commodities. But often, what you see and where the benefits of perps really come in is you kind of take what can be jumpy, volatile convergence periods when you know that the contract does have to eventually get back to the spot price, which can be concentrated in the market at a specific period in time. And you have lots of market participants all trying to trade that convergence, kind of getting back to the roll conversation as well. People need to keep their exposures open. But with something like a perp that has a continuous funding rate, you're taking a lot of that volatility that can occur and you're smoothing it out over the duration of the time that you're holding your position. So in a lot of perps exchanges, funding's calculated on an 8-hour interval. It can be paid at various different intervals, but it's a lot more granular of a way to measure how far the perp price has deviated from spot to try to bring it back, rather than relying on this fixed jumpy point in time that we see in the dated markets.
Yeah, that was the biggest surprise to me, is how much more ongoing, I think is the right way to put it, how much more ongoing the price anchor is versus the price anchor gets stronger with typical futures. And is it the same with swaps where the price anchor tends to get stronger the closer you get to the expiry date?
With swaps, I think it's a bit of a different context because we're talking about, more bilateral arrangements. It can kind of be fixed to whatever the terms are. So I think it is more of a comparison to make in the dated futures world. But to kind of add to the granularity on Hyperliquid, for example, that premium, how far the perp is trading away from spot is actually being sampled kind of within the calculations every 5 seconds or so. So it's like it's being constantly informed by market dynamics instead of kind of what it is in most cases, delivery doesn't actually happen in the dated markets. It's important for the markets where it does happen and for the producers who do need to hedge, real physical delivery obligations. But for most market participants that just want short-term price exposure, they have no interest in taking delivery. And if anything, it's something that they fear of getting assigned, to take delivery at an exchange.
What do you mean? Are you telling me all these traders don't have storage facilities for hundreds of thousands of barrels of oil and wheat? That's shocking. No, and it makes sense. And I think one thing that becomes super important then, if we have the system that's really reliant on pricing and price changes, is the oracles, is how the prices are determined. Where are these reference prices coming from? And I think when we talk about the CFTC and jurisdiction here, with the enforcement era sort of push things outside the US, what that means is that you probably don't have US jurisdiction over those exchanges and the reference prices that these oracles will be using. So how do you think the CFTC and other regulators should be thinking about where these reference prices are coming from?
Yeah, I would just start with kind of equating oracles to a much more familiar, TradFi concept when we think about benchmarks and traditional futures and swaps markets. So the idea that you have, a reference index or a reference number that's being used to help settle a derivatives contract is not something that's really new or innovative to the markets. It's existed for a long time. And oracles for DeFi perps are just another instance of kind of that same dynamic. And I think that with any kind of reference construction, really the objective is to make the cost of manipulation far higher than any benefit you would supposedly get from accomplishing that manipulation. And so things that factor into that, you want a really robust and diverse set of input prices so that no false print on any one exchange can, be unduly weighted and actually calculating the price that's then fed into the perp stacks and used for things like mark prices and so forth. So you really want a broad base of inputs. And then usually, you'll also see some sort of smoothing function that goes along with Oracle calculations where you're taking a weighted average or you're imposing a time delay or other smoothing instances to try and like filter out any noise you might see coming from the oracles. So I think that like Oracle construction is important. And what's great about a venue like Hyperliquid is how much of this can be outsourced in a way to market participants. With HIP3, for example, we see a competitive marketplace of deployers, and Oracle construction is part of what they are responsible for when they're creating these markets. And so you really get these market incentives to build robust and secure oracles in a way that, we might not even see in traditional markets where there are kind of centralized parties that are always responsible for maintaining important indexes and oracles and references.
And the only thing I'll add, Brad absolutely nailed it, but just to emphasize one point that he made, often we hear from crypto skeptics who want to paint crypto as being more volatile or more risky than TradFi about past instances of Oracle manipulation. And of course, over the history of crypto, there have been some relatively famous examples where this has happened. But I think Brad eloquently explains the fact that these risks are not different from the risks of manipulation in traditional markets. However, the mechanisms in which those risks can be addressed in crypto are actually superior in theory, and I think soon to be in practice. And that's where we all have to remember that crypto is extraordinarily new. I feel like there's a strain of thought now, which is crypto's been around for so many years. It's been here for all of, almost 20 years since Bitcoin was created, although not even. And so certainly we must have worked out all of these issues by now. But the truth is that DeFi as a concept has only existed for about 7 or 8 years in a serious way. And Hyperliquid only launched 2 or 3 years ago. And so this really is a very nascent space where there's a lot of room to run and a lot of innovation left to do before we see it in its final form. But I do think, as Brad explained, in its final form, crypto is much more resilient, and on-chain financial infrastructure is in so many ways superior to what the traditional financial system can offer.
Yeah, and let's talk about that resiliency for a second. Before we do, though, I got to say a quick thank you to Jake for those listening. He coughed, but he put himself on mute when he coughed, which was very considerate. A lot of people don't do that, so thank you, Jake. It helps with my editing on the back end. I appreciate that. When it comes to centralization, decentralization, that's obviously a big buzzword in crypto. A lot of people are going to be familiar with that. How do you guys think that regulators should be thinking about validators and who controls the validators and who they are, so that you don't have one party that is in control of a substantial majority of them?
I think that regulators should look at the nature of validators as providing some guarantee that there is not a single person or group of persons under common control who can abuse the system in a way that requires users to trust that one person or group of persons in accessing the system and knowing what type of service they're going to get and being in control of their own funds. And I think that really is a case-by-case analysis. Bitcoin has different security and decentralization risks compared to Ethereum, compared to Solana, compared to Hyperliquid, compared to any other layer 1 blockchain. But ultimately, the question is there some credible neutrality where the user can feel confidence that they are in control of their own financial well-being when they are using that system? And I think really importantly for Hyperliquid, it is a very new blockchain, and it is currently going through a process of progressive decentralization. We see this in every single blockchain. In its earliest years, it is far more centralized than it is later on. This was true for Bitcoin in 2010 when Satoshi was essentially in control of the project. It was true for Ethereum in its early days, leading up through the DAO hack when the chain was rolled back. It was true certainly for Solana in its earliest days before it became significantly more decentralized. And I think we're seeing that same process play out for Hyperliquid, just as it does for so many other layer one blockchains. And decentralization ultimately is a spectrum. There is no magic point that you need to reach to then call yourself sufficiently decentralized, even if that term has been thrown around in the regulatory world for quite a while. The question is just analyzing what the risk is and then allowing the user to decide whether or not they want to take on that risk.
When it comes to DeFi and the risks that people are taking on, when I was doing the research on swaps, it became clear to me where the issue had been in the 2008 financial crisis, with counterparty credit risks being chief among them, where you have all these back-end deals being done and things are papered, sure, but the amount of leverage that your counterparty has, you might not be fully aware of. That really changes when you bring things on chain. And to me, that is the best example of where this is a net new technology with the automated liquidations and so many other aspects of it. Could you guys talk to what's the best way to say this? I know some regulators are worried about leverage, right? And naturally, and I am too, right? Everyone's naturally worried about leverage. That was part of the reason we had the 2008 financial crisis. It's why we had the Great Depression. But leverage is a lot different in this situation, isn't it?
Yeah, and the concern is not necessarily even just leverage for leverage's sake. It's the idea of not having visibility into where leverage is concentrating within a financial system. And I think this is one of the key drivers leading up to the 2008 financial crisis, and the interrelatedness of all these different parties who are participating in the market, but really that risk was highly concentrated in certain, individual counterparties that themselves were exposed to other counterparties and so on. So that's the first piece of it. And the second piece is thinking about, okay, given that there is leverage in a system, how do we account for and how do we deal with default risk from a system-wide perspective? So it's one, how do we identify where leverage is? And two, how do we deal with it in the event that, parties do need to be liquidated? And the TradFi response to this, in good measure, was the central counterparty clearing framework and the default waterfalls that we see in practice now, where there's a pool of funded resources being deposited margin from the trader and from the FCM that intermediates it. And then you work through, a waterfall structure through guarantee funds, through skin in the game from the CCP and some other, end of waterfall unfunded mechanisms. What we see when you have on-chain leverage trading environments is really what's enabled both by the technology and from a visibility perspective. And so you had mentioned automated liquidations. That's something that's not really possible in TradFi in the same way, or at least hasn't been implemented in a system, where we do have manual intervention in the markets. We have brokers calling up and making margin calls, and you have time to post margin. And it's really relationship based in a lot of ways. And there's some inefficiencies that come from that too. But if you're getting a margin call Friday right before markets close and you need to post additional margin, but your bank is closed over the weekend, there can really be difficulties in meeting those calls and lead to more systemic vulnerability due to the lack of access to capital. And so, on a system like Hyperliquid, we see, the 24/7 trading component, the automatic liquidations. We also have other, default management systems in place that can kick in, if an initial liquidation doesn't go through the HLP vault. And then finally, working down to auto deleveraging in cases to prevent bad debt on the platform. So even though these are different implementations of how to address leverage in a system, they do have familiar parallels in TradFi, and given kind of the technology that we're able to use in an on-chain environment, I think it's worth kind of explaining to regulators and working to educate them on how these aren't necessarily bad changes. They're just different implementations.
Yeah, and in some cases, a net positive, right? Like a big upgrade from what we have in the existing traditional financial system. One thing that we don't have in the traditional financial system, having seen internal banking ledgers, is smart contracts, right? A lot of the internal bank systems are dated, they're old, they're vulnerable, frankly, but smart contracts are a net new technology. And I think one thing that's been on people's radar a little bit more now is just the risks involved with smart contracts, right? Where some are immutable, some are upgradable. Oftentimes people aren't sure what's what. How do you guys think that regulators should be thinking about that? That this need to continually improve smart contracts on one hand, but then the risk that comes with that? Because that to me is a really important question that we're going to need to sort out.
Yeah. Well, in the first instance, I would say upgradability is very important if we want these products to be commercially competitive. We've been building in this space as an industry for many years, and I think what we see and makes perfect sense is that it's very difficult to launch a product in its final state, never make a change, and then have it remain commercially competitive with new innovative products that come to market after the fact. And so if we want crypto to be competitive with TradFi and to build products that people actually want to use and actually make a difference in the world, then those products need to be upgradable. They need to be able to change with the times and be improved over time. And also they need to be made more secure by the ability to address potential bugs or vulnerabilities that may come up. So I do think we need to approach this question from the fact of upgradability as a necessary component of the DeFi world or the on-chain financial world, and then treat that question as how we make them as secure as possible. And I think this is a cybersecurity issue more than anything else. We have seen in the last month a couple of exploits and vulnerabilities that have been, I think, quite damaging for the reputation of DeFi. But these were not unique DeFi vulnerabilities. They were, in so many ways, ordinary cybersecurity issues where keys that controlled upgradability were not properly secured, or where the risks of the economic exposure of certain assets in a protocol weren't properly managed. And so what we need to do as an industry is make sure that we are developing and following best practices to ensure that those kinds of vulnerabilities aren't exploited. And then also treat this question just the same as what we were discussing before about the question of validator decentralization. I think it's important to look at upgradability as a feature that can be made more secure through decentralization, where there is not one party trusted to make those changes. And so I do think this is a very important and critical piece of the industry that is, again, still nascent and has a lot of room for improvement.
Yeah, it's such an important point, too. And if you look back in any example in history, I mean, I was reading the biography of Cornelius Vanderbilt, and when they started with steamships and they first put steam engines onto the boats, which is where they went before they went onto the railroads, they were blowing up all the time. People were dying. Like, it was way worse than any DeFi hack. Like, this was very serious. And it was all the headlines in the newspapers. And that's what happens when we have a new technology. They make headlines because people are curious. They don't know much about them. There's a lot of fear mongering, and it's easy to just say, oh, this is danger. But imagine now if we said, okay, well, steamships are too dangerous. You don't get steamships. You don't get railroads. You don't get cars. Like, you don't get North America as it is today. And there's so many benefits that we've seen through these technologies having gone through bumpy times. And like you said, this technology is so new, and we're still seeing it work out. And so hacks, well, yes, they can happen, and probably I'd say less so than they happen in the traditional financial world. They just get publicized a little bit more. This is still a net new thing. So anyways, that's me on my soapbox. I mean, look, I think it's pretty clear that this is an important technology. This is a technology that Americans should want in America, that every country, frankly, should want in their country. And you don't need to be afraid of new technologies because you don't understand it. And if you listen to this podcast, you probably now understand it better than most people. So thank you guys for taking the time. I have to say, before we stop recording though, when I sent you the questions, those are some touchy points. And I wasn't sure, if you're going to say, hey, we can't do that. But for everyone listening, they didn't say a thing about the questions. Jake and Brad both just said, we're looking forward to it. They helped me edit the script. And that, I think that's really important, and that's telling about what you're hoping to accomplish here. So thank you both.
Really appreciate that. Thanks for having us.
Thank you.
I told you that was a fun one. So putting this together was really enjoyable for me. It was a pleasure to speak with Jake and Brad, who were so generous with their time. Also really grateful to the CEO of Architect, Brett Harrison, for joining me to talk about Architect and Perps in general for this episode, as well as Ryne Miller, a partner at Morrison Foerster, Mike Frisch, a partner at Croak Fairchild, Katherine Kirkpatrick Bos, general counsel at StarkWare, as well as David Schaefer of Coinbase's legal team, who's focused on their Perps products. Also have to give a shout out to the CFTC for not shying away from answering these hard questions and tackling them head on. Special shout out to Chairman Selig there for the work he's doing. I think I speak for the entire industry when I say thank you for that. And thank you for listening. Like I said, if you've listened this far in the podcast, that means you're one of the smartest people on the planet. You're also incredibly good looking and charming. And so I'm really glad to have you listening and sticking around for this. This podcast is part of my mission to help people understand the legal layer of emerging tech so that we can live in a world with transparent and well understood rules that are applied fairly to all. You can stay updated on new articles and podcasts by subscribing to the Law of Code by searching online lawofcode.fm. So instead of .com, it's lawofcode.fm. It's literally a super short email. I actually haven't even started sending them yet. It hasn't launched yet. It's free for now. I may charge for it in the future, so you can subscribe there. Now, that was a really heavy episode. It took me, as I said, probably over now at this point, 100 hours non-billable. I did all the research myself. I coordinate all the guests. I do this recording. I do the editing on the back end. Shout out to my wife for, again, putting up with me working another weekend, the entire weekend, really early till really late at night. But that's not me complaining. Like, I love doing this. This is so much fun. The only reason I'm saying that is I want to do more of this, which is why I'm speaking with some sponsors. When I do onboard sponsors, I will only be working with world-class people. I will have full discretion over editorial control. I will never give that up, and it will never be pay to play. There's nothing that someone can pay me to get into this podcast. It's all merit-based. Now, if I do have relationships with people, I get to know them better. And like I said, I'm only working with world-class people. So there will be people featured who are sponsors, but that is all merit-based. And I think that's important to know because, look, journalism, which I don't even consider this journalism, I consider it more education. This is important to exist in the world, and really it's part of my mission. So I'm going to make that happen. Sponsors will be a part of it. If you do want to sponsor the podcast, please reach out to me. I would be eternally grateful for that. To everyone else, thank you so much for listening. It was a lot of fun to record this. We've got upcoming episodes from the Securities Exchange Commission. We've got upcoming episodes on prediction markets. So make sure you subscribe and I don't really care if you like it, but just subscribe so you get this when it comes out. Thank you, everyone.